back to another episode of the Investor Financing Podcast. Today we're here diving into a powerful but often misunderstood strategy in SBA lending, and it's called Pari Passu deals. If you've never heard that term before, don't worry, we've got the expert with us. Joining me is Beau Eckstein, an SBA loan advisor with over 25 years of experience helping business owners get the funding they need to grow, expand, or acquire businesses. Beau specializes in complex deals most lenders won't even touch. And he's here to explain how these split lender deals actually work. Beau, let's break it down. Let's start from the top. What exactly is a Pari Passu deal in the SBA world, and how does it differ from a traditional SBA 7A or 504 loan?
Well, right now on the SBA 7A loan, we're capped at a $5 million. So many people are buying businesses that are 8, 9, 10, $12 million. Well, there's a shortfall of capital that does high leverage financing in those loan amounts. So some banks offer Pari Passu, which is basically a first and a second. It's two loans. It's an SBA 7A loan for $5 million, and then it's a conventional loan for, it depends. It could be $1 million, it could be $2 million, $3 million. The same lender typically makes these Pari Passu loans, and both of those liens are in first position, meaning they have equal rights if there's a default. So many banks will do Pari Passu deals if there's real estate because it's collateralized, right? Some banks prefer to do SBA 7A deals over 504. So they would say, oh, well, we could do this Pari Passu versus taking it 504. And some of them don't really do 504, and 504 is a little bit longer process. So on a real estate deal, it makes sense. Now, not all lenders do Pari Passu. I mean, actually, very few do, even with real estate, because that other piece of the loan, the conventional loan, is not guaranteed, right? Only the SBA has a guarantee, and that's up based on the loan amount, is partially guaranteed by the federal government. So when you get these larger transactions, you got to figure out which one of our funding partners would be able to handle that. And there's not many that do it, and there's not many that do it without real estate.
Okay, so glad you mentioned that, because my next question was going to be, does real estate always need to be involved for a Pari Passu deal to make sense, or can this structure work for straight business acquisitions as well?
Right now, I have 4 lenders that will do non-real estate Pari Passu deals. The rest of them will do them, but only if it's real estate involved. Now, you can also, on real estate deals, you can also do the 504 like we were just talking about. But there's reasons why you may want to do a 7A with a conventional piece. And we could dive into that later. But to answer your question, yes, we can fund them. We do them, and you can do conventional loans with no real estate. Meaning, if there's a collateral shortfall, which there's going to be, the lender has to look for additional collateral. So if you own a primary residence or rental properties, they could lien that. But let's just say you didn't own any additional real estate. You were solid financials, and you had no additional collateral. Could a bank do this with no real estate, even without collateral? The answer is yes.
So just to be clear, do all SBA lenders offer Pari Passu structures, or is this more of a niche offering?
With deals without real estate, Pari Passu are very challenging to get funded. We have about 4 solid banks that we work with that were able to get these deals done. So many of them don't offer it. Many of them only do SBA loans because of the guarantee. So doing a conventional loan alongside of a SBA loan, and that bank is lending the conventional on the SBA, well, if that deal goes bad, they're not getting any guarantee on that conventional loan.
What does it take to actually get a Pari Passu deal done? Are there key steps or common pitfalls borrowers should be aware of?
On the last deal, the borrower went direct to 2 banks, major SBA players, and they both couldn't get to the finish line. So what I did is I listened to the story and figured out why the other 2 banks were having issues with the deal. It was actually a very clean deal, very clean. It was just a non-collateral deal, a big loan. But if you tighten up the weak links of the deal, I think taking the time in the beginning, and the banker, we call him BDOs, the business development officer, we took our time and we really plugged any possible leaks in the boat before we presented it to an underwriter. And then we were able to get the support of his SBA division head, the manager of the SBA division. And then all we had to do from there once it went through underwriting, is get a sign off from the head of the bank, right? Because on bigger deals, sometimes usually the SBA credit officer can just sign off on deals to say $3 million. They usually have a limit, but usually they have a guideline. If deals are bigger than this, we need the head of the bank to sign. And that's on this type of deal we did. So we can get these deals done, and eventually they may raise up the SBA loan limits to 10 million. They're put legislation in specific to manufacturing companies or manufacturing businesses that have certain NAICS codes. So perhaps in the next 6 months or so, we can do manufacturing businesses up to 10 million, but everything else at this point is still going to be at 5 million. So I do believe we'll see more of these pari passu deals.
Why do you think so few lenders entertain these deals? Like, what makes them complex or risky from a lender's perspective?
Well, the lender's lending 90% typically of the total acquisition price plus working capital. And there's no collateral or very little collateral. So it's very risky. And on this deal, it's $2.2 million conventional. If that deal goes bad, there's no guarantee. There's only a guarantee based on the loan amount of that $5 million. I think it's a 75% guarantee. So depending on the loan amount, the guarantee, how much the federal government will guarantee the loan varies. That's the risk of these deals, is that they have to be very strong. But obviously, the majority of these deals are strong, right? Like in theory, nobody's going to go out and buy a business for $10 million if the deal wasn't strong. Now, on this particular deal, the borrower only came in with $300,000 of his own money on a $10 million acquisition. So that's only 3% of the total project cost, right? But he brought in an investor partner that brought $700,000. So between them, that's 10% of the total project cost. But I think we worked in a little under $800,000 of working capital. So the day he closes, he's going to have $800,000 of working capital. So I always tell people the same thing. The reason I think he's going to get to the finish line, we have loan commitment, we're about to close, is because he has a good relationship with the seller. Because you got to go back, and sometimes you have to negotiate things, and you really want a seller that wants to sell you the business. That's going to help you get to the finish line, especially on these bigger deals.
So pari passu deals aren't for the faint of heart, but as Beau just showed us, they can be the secret to getting bigger deals funded when the math doesn't work with just one bank or one loan. If you're considering a business acquisition or real estate deal that seems too big or too complicated, don't guess. Book a call with Beau and get it done the right way. Visit bookwithbeau.com to get started. We'll see you on the next episode.
If you're looking to acquire a business, stop scrolling on Biz Buy Sell and visit franchiseresalelistings.com. We'll do a customized search. You can get on our weekly distribution where we're sending new inventory weekly to your inbox. So visit franchiseresalelistings.com and opt in today. See you there.
Hey guys, Beau Eckstein here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.